Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to be talking about how to take directional views in the underlying market, either through stocks or ETFs, with the minimum amount of risk by using a trading strategy that I'm very comfortable and one of my favorite strategies, debit vertical spreads. Now, this is a topic for those of you that have a basic understanding of options trading. Either you've already traded calls or puts in your portfolio, or you've learned about calls and puts. If you're brand new to options trading, I do recommend that you take some time to learn about basic option strategies, like such as being long calls or puts, in order to fully understand the concepts that we're going to talk about here today. Now, debit spreads are one of the most efficient ways to gain directional exposure in the underlying market with limited risk. And the key word here is limited risk. It's a slightly more advanced strategy. So I'm going to try to keep things short and sweet, and I think the best way to really teach and learn these types of strategies is to go through as many examples as possible. So I'm going to spend about 15-20 minutes going through the slides, walking you through how these strategies are constructed, when you should utilize them, and then we'll spend as much time as possible going through Options Play that will allow you to go through some real examples of some stocks with some trade setups and show you how to compare these types of strategies with buying a call or put. So before I get started, just a quick disclaimer. What we're going to talk about here today is not a solicitation or offer to buy or sell any specific securities. It is simply just for educational purposes. So today, before we get started, for those of you that are brand new to Options Play, if you've never used Options Play yet, please, you can sign up for a free account for the tools that we're going to show you here today by going to this link here, which I will add to the chat window. So if those of you that are brand new, you can sign up. This gives you free access to Options Play Canada, including bi-weekly options education webinars like the one that you're on here today, and a free on-demand options video library. So if you're still learning, or if you're experienced and you want to learn more, please take a look at some of the videos that we've pre-recorded for you, including these bi-weekly webinars. And lastly, check out the weekly cover call and short put reports for those of you that like to sell options for income. So with that, let's go ahead and get started. Before I do, I just want to get a quick sense of the audience here. If everyone can please bring up your chat window, which you will see at the bottom of your screen. I just want to get a sense for how familiar people are with debit spreads. If you are familiar with debit spreads, please type 1 into the chat window. If you've never heard of debit spreads, or if you've never traded debit spreads before, please type 2 into the chat window, just so I can get a sense for the audience here in the room. Okay, so I think I have a pretty healthy mix of 1s and 2s. Of users who are familiar with debit spreads, but I think there's a very healthy number of you here who are brand new to this strategy. So if you're brand new, don't worry. We're going to go over, first of all, what are debit spreads so that everyone understands what they are. We'll then cover when should you actually utilize the strategy, and then more importantly, how do you actually trade the strategy efficiently, and how do you manage these positions once you're in them. And then, like I said, lastly, what we'll do is we'll go over Options Play and show you as many examples as possible. So what I'll do as part of, for those of you that are brand new to debit spreads, I'll also do a very brief introduction of just buying a call or a put, because a debit spread is really graduating from buying calls or puts into a slightly more advanced strategy. But to really understand debit spreads, you have to first understand buying a call and buying a put. So debit spreads, there are 2 types of debit spreads, and I'll break down both of them for you here today. You can trade what's called a bull call vertical or a bull call spread. This is the bullish version of a debit spread, or you can trade the bearish version, or a bear put spread, or a long put vertical. So those are the 2 strategies we're going to go over here today, and we're going to show you how these are constructed, why you should utilize them, and more importantly, how you should utilize them. So in order to understand a debit spread, it's first important to understand a call or a put. So first, I'm going to give a very simple example. We're going to talk about stock XYZ that's currently trading at $100. And in this particular case, we're going to say that we're bullish on this underlying stock. So we think that stock XYZ is going to go higher from 100 to, let's say, we think it's going to go up to 110. So an option strategy, a simple option strategy that you could deploy in this particular environment is simply buying a call option. And that strategy is a fairly simple strategy to understand. And what I'll do is I'll just quickly explain it. So let's say we want to buy a 100 strike call, and let's say that call costs $4. So what you're effectively doing with those $4 is you're controlling 100 shares of stock for $4, which gives you an implied leverage of about 25 to 1, because you're controlling a $100 stock with just $4 a share. And the benefit of this strategy is the fact that you can have that amount of leverage and limit the amount of risk that you have, because when you buy a call option, your max risk is what you pay for that call option. So normally if you buy a $100 stock and that stock plummets from 100 to, let's say, $90, you would lose $10 a share. If you bought a call option, instead of losing $10 a share, you would only lose $4 a share. So not only do you get leverage, you also get control. You also have control over your risk. And the upside to this strategy is that you also still have unlimited reward, meaning as long as the stock continues to go higher and higher, you will continue to make more and more money if the stock keeps going higher and higher. So you really get this asymmetrical risk. And one of the reasons that a lot of people like to trade options is because of this asymmetrical risk, where if things go south, you have limited amounts of risk, but if things really go in your favor, you can make more and more money to the upside. And the max loss here is that you can lose $4 if the stock is at $100 or lower, which is not as great as the stock, because if you bought the stock at $100 and it stays at $100, you lose nothing. In a call option, you actually lose money if the stock doesn't move. So the downside to buying a call option is the fact that this strategy only breaks even at 104. So this stock actually has to move from 100 to 104 just for your stock to break even, which means that the stock really needs to move substantially beyond 104 in order for you to make a profit. So that's the downside that you have with buying a call option. You get to control 100 shares of stock with just, $100 stock with just $4. You get unlimited upside, and the downside to all of it, or the catch to all of this, is that the stock really needs to move from 100 to 104 just for your strategy to break even. So you really have to expect this stock to move to 106, 107, 110 in order for this strategy to really be worth your while. If you really just think the stock's going to go from 100 to 105, then this may not be the right strategy for you. So one of the reasons that we want to look at debit spreads is really because of the fact that call options typically have a break even that's fairly large. So, the stock needs to move 4% just for you to break even, meaning you have to, again, expect a 6, 7, 10% move to really make any significant profits. So this is really the reason why we want to take a look at debit spreads, because debit spreads is similar to buying a call option. So in this particular case, a vertical debit spread, we're still going to buy that same 100 strike call at $4, which is what we have here. We're buying this 100 strike call for $4. This gives us capped losses to the downside with unlimited gains to the upside. However, because of the fact that when we're paying for these types of options, we're paying for unlimited upside. But in reality, do you really think stock XYZ is going to go to $200 between now and expiration? Chances are you don't, which is why for a debit spread, what we're going to do is we're going to sell a higher strike call. Let's say we sell a 100 strike call and we collect $1 credit on it. So now, instead of risking $4 a share and taking $4 to control a $100 stock, now it only takes $3 to control that same $100 stock. So now what we've done is we've reduced our risk from $4 to $3. And what we've done is we've capped our reward from unlimited to $7. So you might ask yourself, why would I ever cap my risk from my reward from unlimited to $7? And the answer is really because we want to lower our break-even costs. So now instead of the stock having to move from 100 to 104 to break even, it only has to move from 100 to 103 to break even. So the original trade looks something like this, where we bought a 100 strike call for $4. So our break even at that time here was about 104. Now, by selling that 110 call against it, we're going to move our break even down to just 103. So the stock doesn't need to move as far in order for our strategy to be profitable. Now, I don't want to draw too many arrows on our chart to make this confusing, but effectively what we've done is we want to bring down the break even so that the stock doesn't need to go as far in order for us to be profitable. So now the stock only has to move 3% for this strategy to be profitable. And what happens is, in the expectation that if we think the stock's going to go from 100 to 110, originally if we had bought the call option for $4, our risk reward was $4. We're risking $4 to make effectively $6 in the call option trade, which is about 150% gain, right? So that certainly sounds like a pretty nice gain. But in the vertical spread, if this stock goes from 100 to 110, what we're doing now is we're risking $3 to make $7. So now notice that return, $3 into 7, is a 233% return. So the same move, now that we, for the same trade or the same expected move, instead of risking $4 to make 6, we're now risking $3 to make 7. And notice the huge difference in return, from 150% return to 233% return. That is a type of additional return that you expect when you're trading a debit spread versus outright buying a call. So this is really the reason why we want to explore using debit spreads when we have an expected directional move, because in reality, we don't think the stock is actually going to go to infinity. We have some reasonable target as to where we think the stock will go, and that's why we want to sell an option at that point so that we bring in some money to reduce our capital outlay, reduce our risk. And what that does is it amplifies our returns when we're correct. And if we're wrong, we're actually risking less money on that trade than if we just simply bought a call option. Conversely, on the put side, if you were bearish on stock XYZ, absolutely same thing. So now, just instead of you're bearish on a trade, you buy a put option. So now in this example, if let's say we bought a $100 put and we spent $4 for it, our max risk is $4. Our max reward is unlimited. Basically, as long as the stock continues to move lower and lower, we'll keep making more and more money. And this will have a max loss if the stock is at $100 or higher. So you'll risk $4 a share if the stock doesn't move any lower or moves any higher. And our break even on this trade is 96. So the stock needs to actually decline by 4% just for this strategy to break even. So again, what we want to do in order to maximize our returns and minimize our risk is to simply trade a vertical spread. So now we're just doing the exact opposite. We're still going to buy that 100 strike put for $4, but what we're going to do is we're going to sell a 90 strike put for $1. So again, our net credit that we're going to bring in here is just going to be $3 instead of $4. And what that does is it reduces our overall risk from $4 to $3. Our max reward is now capped at $7. But again, when we're bearish on stock XYZ, chances are we don't think the stock's going to go to 0 by next month or 2 months or however long your trade expiration is. But you might have a reasonable target. So you generally want to sell a put at that lower target price so that you bring in some money, and that lowers your break-even cost. So now the stock doesn't have to go from 100 to 96 to break even. It only has to move from 100 to 97 to break even. So if the stock moves down to 95, you'll have more of a profit than if you had just simply bought a put option. And your break-even price moves down up to $97, and you overall reduce your risk on the overall trade. So those are the reasons. So that's how you construct these debit spreads. And I've talked a little bit through the benefits and why we should do this. But just to recap, debit spreads are one of the most efficient ways for you to gain a directional exposure. And when I say efficient, what I mean is to have the lowest amount of risk with the highest amount of possible return if the trade goes in your favor. And if the trade goes against you, you have the least amount of risk. And this is a strategy that's suitable when you expect a large bullish or bearish move in a stock or ETF. Typically, I think the best a good use case for debit spreads is if when you've identified a breakout or a breakdown, so you're expecting a relatively sized move in over a relatively short amount of time, many times useful or very useful for strong momentum stocks that are moving a lot. And lastly, this is not a strategy that you want to use if you're expecting a modest or neutral move. Again, do not use it when you expect a neutral or modest move. So if you think the stock's going to go from 100 to 103, not a right strategy to use. There's a whole nother strategy that we're going to cover in 2 weeks called credit spreads that are far more useful and far better for your portfolio when you're expecting a small or modest move. So the benefit of this strategy is the fact that you're able to take the same directional exposure but have lower total risk. You have a better break-even price. And lastly, for those of you that are familiar with time decay, whenever you're buying a call or a put option, you have time decay that's working against you. So to offset some of that time decay, when you're short that other leg, that time decay gets offset against each other. Not completely, but it offsets some of that time decay, which means that you have a little bit more time for your trade to work out than if you simply bought a call or a put. So those are all the benefits to why someone should consider using a debit spread. So whenever you have the ability to trade these debit spreads as opposed to just outright buying a call or a put, these are the additional benefits that you can expect from trading debit spreads. So, I've talked about conceptually buying an at-the-money call or a put and then selling a further out-of-the-money call or a put against it to bring in some premium. But let's talk some real examples here. So when you're talking about options, you always have to think about what expiration date, what strike price. So we back-tested the debit spread strategy across a lot of different types of expiration dates, a lot of different strike prices. And what we found is that the optimal debit spread is you generally want to pick expirations that have a minimum of 5 to 6 weeks from expiration. And the reason for this is because longer dated options will allow you to minimize theta or time decay. So whenever you're buying any type of options like a call or a put, time decay is working in your favor. And you want to do everything you can to minimize that time decay. And debit spreads, number one, because you have a short leg, will help you minimize that time decay. But another way that you can minimize it is simply buying a longer dated option. If you bought even a 6-week option, but you only want to be in the trade for 2 weeks, that's okay. You should still buy that 6-week option, just sell it off 2 weeks into the trade. You don't want to buy a 2-week option because during those 2 weeks, you'll have a lot of time decay. So that's why even if you intend on being in the trade for much shorter than the expiration date, you should still always buy at least 5 to 6 weeks out when you're buying any type of options, and that includes if you're buying a call or a put. Now, as far as the strike prices go, we tend to find that you want to buy a slightly, either at the money or slightly in the money option. So about a 50 to 60 delta call or put. And then when it comes to selling that out of the money call or put, we tend to find that about a 10 to 15 delta call or put is suitable. So when we talk about deltas gives us a sense for probability. So when we talk about a $100 stock price, and we think that the stock is going to go higher, when I'm referring to a 10 delta call, so let's say we sell that 110 call against it. So we buy the 100 call, we sell the 110 call. What we typically do with options is we express the 110 as, instead of a strike price, instead of a dollar amount, we express it in probability terms. So a 10 delta call refers to a strike price that has about a 10% chance of the stock reaching that price. So when we say that the 110 strike has a 10 delta, that means there's only about a 10% chance that the stock will go from 100 to 110 by expiration or higher. So the higher you go, the lower the delta. And delta always uses probability to determine what is the strike price. And we always use delta to help us determine this because $100 stock, if it's a very volatile stock, delta would naturally choose a higher strike price. If it was a stock that doesn't have a lot of volatility, it would naturally choose a strike price that's closer. And you always want to use probability to help you construct your vertical spreads. So when you follow these types of methodologies, what you'll tend to find is that the premium of the short leg that you receive will roughly offset about 10 to 20% of the premium of the long leg. And with this type of strategy, these are typically lower probability of profit trades, usually winners in the 30 to 40% range. A lot of people, will say, well, that sounds really low. But keep in mind that risk to reward and probability are offsets of each other. So if you have something with relatively low probability of profit or low probability of winning, you typically will have a high amount of risk to reward. So meaning you are potentially making a lot more than what you're risking. So this is really some of the benefits of trading debit spreads versus other strategies may have very high probabilities, but they typically have very poor risk to reward. So with options, with debit spreads, you will typically find lower probability of profit, but much better risk to reward. And what I have here on my chart here is an illustration of what it typically looks like to trade debit spreads versus credit spreads. So this is a strategy that we're going to cover in a couple of weeks, credit spreads. Today we're going to talk about debit spreads. So as you can see here, I have a chart here of a stock that was trading in a tight range, was starting to trade in a tighter and tighter range until one day it started to break out to the upside right around here. And what we're doing here is when we're trading this, we're expecting a breakout back up to a prior high. So let's say we thought it was going to move back up to around right here. So what I would do is you would basically go long the stock from around right here, expecting a move back to that recent high. So this is typically the type of move that you would want to deploy a debit spread for, because it allows you to take advantage of this big move to the upside with a small amount of risk. Versus for those of you that are trading credit spreads, this is more useful for when a stock is trading in a sideways range within a support or resistance level. You're better off when you expect more of a small, modest move or just more of a sideways move. This is useful for selling credit spreads. So that is a strategy we're going to cover in a couple of weeks that will allow you to take advantage of these small, modest moves of overbought and oversold conditions versus when you're expecting a big move in the underlying stock. That's when you want to use a debit spread. So that just gives you a sense for, when you're trading debit spreads, you typically will trade very infrequently in the same symbol versus when you're trading credit spreads, you might be trading multiple times on the same symbol within a short time span. With debit spreads, because you don't see these large breakout opportunities very frequently, you're not going to typically trade debit spreads on the same symbol over and over again. Versus credit spreads, you may trade on the same symbol many times over within a short period of time. So lastly, with these types of trades, one of the reasons that I really like to trade debit spreads is not only because of the fact that you're able to take a very efficient directional view in the markets, but more importantly, it's actually also very easy to manage. Most long strategies with options tend to be easier to manage than short option strategies because of the fact that you have defined risk and you have fairly good upside if the stock goes in your favor. So when you're trading these debit spreads, number one, you want to time your entry with an expected large move in the underlying stock. So you always want to time this when you expect the stock to make a breakout, or if you expect the stock to make a big move for various reasons, whether it's a technical reason or a more fundamental and news-based reason. You want to time it with when you expect that move to actually happen. Now, as far as holding these positions or managing these types of positions, you always want to cut losses if the move that you're expecting does not materialize. So if you expect a stock to, that's trading within a range to break out from that range, If you expect a stock that's trading within a range to break out from that range, and when you get that kind of breakout, and it doesn't really continue to move higher, it just kind of moves right back into it, and the expected move that you're expecting doesn't materialize, it's time to cut those losses on those particular trades. With these types of long option trades, whether you're long the call or put or even a debit spread, these are trades that you want to exit before expiration, either at a gain or a loss. But if the stock moves, even if you don't get the move that you're expecting all the way back up to the previous high, if it just moves halfway there and you're getting closer to expiration, you got to start taking some profits. You don't want to just hold on to these trades all the way through expiration. And the general rule of thumb that we have here for these types of trades is you want to cut losses at a 50% loss. So if you purchase a call option or a debit spread for $1 and it's trading at 50 cents or less, so you lost 50% of what you paid for, it's usually time to cut your losses at that point. If the stock does go in your favor and it does go in the direction that you expect it to, we generally will say that you want to take at least partial profits on the trade at least 75 to 100% gain. So if you buy a call option or a debit spread for $1 and it goes up to $1.75 to $2 in that range, it's time to at least start taking partial profits. If you're only trading 1 or 2 contracts, you should probably take all of your profits at that point. But if you're trading 5 or 10 contracts, you would want to take off at least half the position at that point to remain the other half in your position, so that you are effectively taking on the same trade with a fraction of the original risk that you have for any extended moves to the upside or to the downside, depending on whether you're bullish or bearish on that underlying stock. So that's how you would typically go about utilizing debit spreads for your trading. So with that, I think the best way to really better understand the strategy is to actually jump over to Options Play and show you guys some real examples of some setups and show you how to utilize our tools to help you find and optimize these debit spreads. So what you see on your screen right now is Options Play Canada. This is, again, a free tool for those of you that have access to Options Play. If you don't, I just put another link in the chat window for you to sign up. This tool is divided into 3 sections. We have trade ideas and watch list here on the left-hand side of our screen. In the middle is our security analysis panel, and on the right-hand side is trading and income. We call these 3 panels the what, the why, and the how of options trading, because when you start your day, you want to know what symbols should I pay attention to. So we have trade ideas that gives you fresh bullish and bearish ideas every single day, and a watch list that allows you to take advantage of creating symbols that you want to stay on top of. The middle panel is our security analysis panel. This is really designed from the ground up to give you snapshot technical analysis data so that you don't have to pull up a chart, go through pages and pages of fundamental or reports to get a sense for what is the direction of the stock. So what we have is a 1-month and 6-month trend indicator and a relative strength score to give you a sense for both trend, so how the stock is performing against its own history, versus relative strength, giving you a sense for how this stock is compared to the overall market, giving you a full picture of historical trends as well as how it's doing relative to the market. Very important information to know in order to get a sense for the direction of a stock. And then lastly, important information such as earnings, dividends, and price action data at the bottom of your screen. And we even show you the trend indicator up here as to how it's changed over time. So not only do you see what the current trend is, but you see how that's changed over time. And once you have that directional view on an underlying stock, you have 2 buttons here on the left that will drive everything here on the right-hand side. So you can either select I'm bullish, and we will present to you 3 bullish strategies on the stock that you're looking at. So in this particular case, we'll show you buying 100 shares of the stock, which is a simple strategy to take if you're bullish on the stock. We'll show you a call option, which is the first strategy we went over here today. And lastly, we will show you that debit spread. So what we do is we automatically show you all 3 strategies. We've picked the expiration date already based on the best practices we just showed you here before. And we've picked the strike prices also based on the best practices we just showed you here before. And what this allows you to do is very quickly have a starting point for three different ways to take advantage of a bullish view on this underlying stock that really progresses you as a trader. So if you're an equity trader, this is the strategy that you're most familiar with. For those of you that are unfamiliar with options, with debit spreads, you might only be familiar with buying a call option. And for those of you that have traded vertical spreads, this automatically constructs for you that vertical spread to start off with. So regardless of whether you're brand new and you're not sure where to start off with, we will show you those starting points. And if you are experienced in trading, what this does is it just applies everything we taught you here automatically right on your screen. And with this, and if on the other hand, if you are bearish on a stock, you can always select the I'm bearish strategy. And now what we'll show you is shorting the stock versus buying a put versus buying a put spread. So this is all designed to help you not only understand where to start, but more importantly, give you the actual expiration dates and strike prices so that you can immediately start researching these strategies and seeing how they would perform. So let's go back to the bullish strategies here for Barrick's Gold. This is obviously a strong stock currently in the market environment that we're in as gold continues to rally to all-time highs. I'm sorry, not all-time highs, to new 52-week highs. And mining stocks have really taken off over the last few months. So, call options and vertical spreads are, in my opinion, one of the best strategies to take when a stock is near its all-time high. Because when it's near its all-time high, yes, you may expect this stock to continue moving higher. However, there's also a higher amount of risk that this stock pulls back to its lows. And if the stock pulls back, you may risk a significant amount of capital while trying to bet that the stock will continue moving higher. So in my opinion, one of the better ways to play that is by buying a call or a call spread that really allows you to take that upside directional view with the smallest amount of risk possible. And again, the key here is to take the smallest amount of risk possible. So to control 100 shares of this stock would cost you roughly $2,400. To buy that call option to control the same 100 shares only costs you $166. But as you can see here on the vertical spread, instead of just buying a September $23 call, which costs you $166, I can sell that $27 strike call against it and bring in roughly $20. And that $20 saves me from going from spending from $166 to $145. So as you can see, as you move from left to right, you are going to risk less and less money. And what we want to do is we want to use our P&L simulator here at the bottom to give us a sense for how much money would we actually make if we were right on this trade. And more importantly, if we were wrong on this trade, how much money do we lose? So if we look at this stock recently rallied from 21 to about 24, almost 25 within a short period of time of just less than 2 weeks. So even if we expect this stock to pull back a little and rally a little higher to maybe the 26, 27 level, so even if we expect the stock to pull back a little bit and then rally back higher to, let's say, 27, what we can do is we can use our P&L simulator here at the bottom to say, what happens if this stock goes to $27? How much money do I actually expect to make from these strategies? If you bought 100 shares of this stock, you'd make a 12.5% return, which, in my opinion, is a very, very nice return for let's say a month and a half. These are the types of returns gold investors have been seeing over the last few months. But as you can see here, if you had bought the call option, that return goes from 13% to 140% return because you're risking so much less. You're putting up such a smaller amount of capital. Your returns get amplified when you do make that same roughly $300 profit on the stock. And lastly, if you bought the call spread, again, because you've reduced the risk from 166 to 145, your returns are amplified. So not only are you minimizing risk, you're also amplifying your returns when the stock does go in your favor. So if the stock does rally up to 27, as you can see, instead of making 140% return, you make 175% return. Now, it's always nice to talk about the upside, but reality of trading is that there's always risk, and that's really the most important thing as a trader to evaluate is what happens if this stock pulls back to 21. Notice it was just there 2 weeks ago, so pulling back to 21 I don't think is a crazy crazy possibility. So if the stock does pull back to 21, this is really what's most important. If you bought 100 shares of that stock, you'd lose 12.5% return, or about a $300 risk. Versus if you bought a call option, you only risk $166. So you've risked half of what you would risk if you had bought the shares. And lastly, if you had bought the call spread, you would risk only 145, because that's how much you are risking when you're trading these strategies. Is what you pay for is the most risk that you'll take. So if you get that pullback, you are risking the least amount of money in this particular trade on the vertical spread versus buying that call option. And this is really why this strategy here on the right has the highest options play score. So we always get questions around what is the options play score? Whoops. We always get questions around what is the options play score. The options play score is really looking at the risk to reward ratio of each strategy and seeing how much potential reward do I have versus how much potential risk do I have, and weighting it by the probabilities of each one. So this one has the best risk to reward ratio because, as you saw before, if the stock goes in my favor, I make the highest return. If the stock goes against me, I lose the least amount of money. And that's really the risk to reward factor that we're looking for. And this strategy here on the right gives us the best risk to reward out of the three strategies here. Now, that was a bullish example of a stock that we think may continue to move higher. But if we look at some stocks like some of the banking stocks, they've really taken a beating recently. A stock like BMO that's been really hovering around that 100, 105 area, really cracked below that some major support around 197 or so and started to break down. So let's say we expect this stock to move, continue to move lower. If you're looking at this type of formation, this almost looks like a bit of a head and shoulders formation. If you look at the neckline of this head and shoulders, it's about $86, which is still a decent amount to the downside left to go. From 94 down to about 85, 86 is still another $10 to go to the downside. Yes, there is the possibility of this stock moving back up to maybe $100 or maybe even 103. The previous resistance level, but the fact that it's broken below this major support level here, I think gives us some indication that perhaps there's a little bit more pain left to go. This was a major support level that just got violated a couple of days ago. So with that, if you have more of a bearish view on a stock like BMO, this is really where we can look at using the I'm bullish strategies here on options play. And again, options play will provide you with these strategies instantly, just for putting in any stock, clicking on either I'm bullish or I'm bearish, and being able to see how these strategies perform. So let's take a look at this. So if I'm bearish on Bank of Montreal around $95, I can short 100 shares of that stock. That would require a significant amount of margin in order for me to do so, even if I'm even able to do so. Some of you in some accounts may not be able to short stock. That might not even be an option for you. Versus a simple option strategy would then be to buy a put option. So now I can buy a put option for $252. So a fraction of the cost to short the shares, if I'm even able to, I'm able to take a bearish view by placing a put option, or I can buy a put spread. So buying that same $96 put, but at the same time selling that $90 put to the downside. So even if I conservatively think that this stock is only going to go down to $90, even if I don't think the stock's going to go down to 85 or 86, if I just think it's going to go down to $90, notice here, if I had shorted the stock, I'd make I would say a fairly measly 5% return, which is not incredibly attractive considering the risk that I take when I'm shorting a stock. Because when you short a stock, you truly have unlimited risk. Just to make about a 5% return, I don't particularly think that's very attractive. Versus if I bought the put option, I'm looking at 138% return. And lastly, because I was able to save myself $50 on the trade from 250 to 196, that amplifies my return from 138% return to 206% return if I bought the debit spread. This is really, again, why this is one of my favorite strategies to trade when I have a directional view on a stock or ETF, because again, I'm able to take that directional view with smaller risk than if I was buying a call or a put. And if it works out for me, I make a higher return because I put out less capital to trade to place that trade. And notice the difference that you see in these types of returns from buying a put to buying a put spread. And that's on the conservative side. Because if the stock does continue to move lower, this is really where sometimes you might be better off buying a put option. So I do, because of the fact that when you buy a put spread, you do have capped gains. If you do expect an outsized move to the downside, so you think the stock's going to move down to 86 or so, notice how if you shorted the stock, you make a 9% return, but if you bought a put, you make a 300% return. The put spread will effectively get capped at its maximum gain, and no matter what happens, even if the stock goes from $94 all the way down to $10, you would still only make a 206% return, versus the put will continue to make more and more money. But again, there's only a reasonable amount of downside that you may have on a stock. So that's why we always typically want to trade that vertical spread, because we usually don't think the stock's going to go to zero between now and September, so why pay for all that upside? Unless you really think the stock's going to make a big outsized move, and if that's the case, sometimes you're better off buying the put option. And many times I get the question from users, well, how do I know? And the answer is put the two side by side, put in your the outlook that you expect on the stock, and Options Play will spit out for you which strategy gives you the higher return. And if you ever look at a page that looks like this, pages and pages that look like this, if you're familiar with an option chain or you use option chains today with your trading, please type yes into the chat window, because this is really the page that we saw a lot of users struggle with when they're trading their options. They don't know which strategy, which expiration to choose, which strike price to choose. And even if you were the type of person who has learned how to navigate these pages and have spent months or years learning how to trade options and trading using these types of screens, what you find is that you might be able to pinpoint a starting point pretty quickly, but to analyze a put option, so let's say I'm selecting, let's say on Barrick's Gold, right? We were talking about buying Barrick's Gold. Let's say I wanted to buy the $20 call option, which is costing me about $4. Well, what happens if I expect the stock to go from 20 to 24? How much money do I make on a $4 call option? I used to have to do these types of calculations in my head, or back of the envelope calculations. And it's really difficult to do it on the fly for single leg. But when we're talking about multi-leg, I'm going to buy the $20 call and I'm going to sell the $24 call for $1, so now my net is $3. How much money do you make when the stock goes from 20 to 24? Even harder to calculate when you're dealing with multi-legs. And this is really why we created Options Play, was because this type of calculation was just too difficult to do on the fly, especially for multi-leg trades. So we created this platform from the ground up to make these types of calculations easier. Not only easier, but also just there are no calculations. You just simply place your the strategy that you want, you put in your outlook into the P&L simulator, and it always spits out the strategy to trade. And many of you that are more experienced with trading, you can always change the inputs. So you can change the expiration date, you can click on modify, you can change a different expiration date. So if you want to move it out to October, you can click on modify and move both strike prices either further down or further up. You can make the vertical spreads wider, and you can really play around with all the different strikes. And we even have a strategy constructor. So if you want to trade more complex trades, so if you want to short a vertical or trade a credit spread or condors or butterflies, you can do that all by the click of a mouse and construct these and move them side by side and really use the P&L simulator to compare them and be able to see how these strategies perform. And once you've constructed them, create your P&L simulator to see how they perform in different market conditions. And this allows you to really play around with these strategies. And once you're comfortable with the strategy you want to trade, you hit the trade button, and we will show you how to enter this trade into your broker's platform. For those of you that are beginners, we even have a strategy checklist really designed to make sure that you understand the risks that you're taking with these types of strategies before you go ahead and place these trades. So those are all the different things that Options Play is really built to help you guys, number one, find strategies to trade, and more importantly, help you guys really understand what is your risk, what is your reward on each strategy, and make sure you understand that before you get into a trade, because the last thing you want to do is buy a put option and then find out that the outlook that you had would not make you as much money as you anticipated, or risk more money than you had anticipated. We don't want that to happen after you get into that trade. We want to make sure you understand your risks and your potential rewards before you get into that trade. So with that, I just want to thank everyone for taking the time out here this afternoon. That concludes what I wanted to show you guys here today regarding how to utilize debit spreads for your trading when you have a directional view in the underlying stock or ETF. So at this point, what I'll do is I'll open this up for Q&A. And I will, you can pull up your chat window or your Q&A window, and you can answer, you can type in any questions you may have on debit spreads or trading with debit spreads. And for those of you that are brand new to Options Play, again, I just submitted the link to sign up for Options Play again in the chat window. Please sign up if you don't have access to Options Play. It is free of charge to everyone in Canada to access Options Play Canada with Canadian securities. So thank you so much. If you have any questions, please type them into the chat window, and I'll answer as many questions as I have time for. So Peter's asking, I know Options Play does calculate the probability of winning for cover calls and puts, but does Options Play calculate probability of winning for debit spreads? Absolutely, Peter. Great question. So you can click on the Options Play score. So let me first reset this to my original strategy. You can click on the Options Play score. And as you can see here, there's a pop. So in this particular case, this vertical debit spread has a 44% chance of winning on this particular trade. So absolutely, all you have to do is click on the Options Play score, and you'll get the breakdown of some of the details of each trade. Dennis, thank you so much. I really appreciate it. Molly is asking, for something like a bearish gold, strong trend and high volatility, might a little longer time frame in the trade be a good strategy? So absolutely. So, what we were looking at here on bearish gold, which is trading around 24 bucks right now. If you thought you needed longer time, absolutely, you can just move it out to October, which will buy you roughly double the amount of time for 196 bucks versus 165 to buy yourself till September. So in my opinion, spending that extra 30 bucks to buy yourself an extra month of time is certainly potentially worth it. You could also do the same thing on the vertical, moving this out to October. So that's only costing you $153. So notice how you can buy an October call vertical for roughly the same price it would cost you to buy that September call option. So that's another way that you can think about vertical spreads, is that it really allows you to take the same directional view with more time than it would cost you to just simply buy a call option. So great question, Molly. Let's see, looks like a couple of other questions here. Doug is saying, would you use this before an earnings announcement, even if we expect volatility to decline? So Doug, that depends. It depends on what your expectations are going into earnings. We typically find that debit spreads are not as optimal going into earnings because if you do get that outsized move, so let's say, for example, let's just say, for example, Barrick's Gold was reporting earnings next week, which it's not, but let's just say it was. Let's say next week, or let's say by September 4th, you would expect the stock to rally to, let's say, 27 bucks, and volatility was to decrease. Notice how you're better off buying that call option. So 143% return on the call versus only a 98% return on the vertical, because again, that vertical caps your reward. So generally speaking, not the most optimal strategy for earnings, because many times on earnings, you're better off buying that call option. But I do have a whole webinar just on trading earnings. So I do recommend that you take a look at that recording to learn more about trading earnings utilizing options. Greg is saying, how does options play account for changing implied volatility? So you can change your implied volatility here using the volatility slider, but I will say, unless you have a real catalyst event like earnings, there really isn't a strong case for changing volatility by a large amount because I don't know about you, but I don't have any tools that forecast where volatility on something is going to be in the future if there isn't a large catalytic event like earnings coming up. You can certainly do so. How do I access the platform for free now? Greg, if you just pull up your chat window, I just put the link into the chat window for you to sign up and register for an account. Peter is asking, thanks. In response to my question regarding probability of winning on spreads, you showed an example of probability winning 44%. What does 44% mean? So 44% means that in this particular case, when we say the break-even price here is $24.53, so the stock's currently at $23, the break-even price is $24.53, meaning the stock needs to move roughly about 50 cents higher in order for this strategy to be profitable. So what we're basically saying is that there's only about a 40% chance that this stock is going to move 50 cents or more in this particular time frame between now and October 18. That's what that 40 or 44% return refers to, is what is the probability of the stock reaching that break-even price or higher by the expiration date. Where can I find historical implied volatility so I can compare it to price and volatility? So Greg, there are lots of different services out there that provide historical implied volatility. However, like I said, that doesn't give you any indication as to where volatility will be in the future. That only tells you where it was in the past. And volatility is a mean reverting it's not like price where you can really forecast it the same way. So generally speaking, I don't know that that's going to help you change. And I will say, notice how so vol currently on this trade is at 35, and this results in a $236 profit. Even if vol makes a massive move to the downside to, let's say, 27, and that's a big move in vol, notice how the dollar amount changes from 237 to 236 or so. So very small amounts. So even if volatility makes a big move, it doesn't have a big impact on your P&L. So keep that in mind versus when the stock price moves, notice how much the price changes. So even a 50-cent move results in a huge return in your strategy versus volatility will have a relatively small impact. So keep that in mind when you're thinking about volatility. It doesn't have as large of an impact on your P&L as many people might expect. John is asking, you talk about a break-even price, but when the price of the call goes up, I've made money. So isn't break-even a bit misleading? Yeah, John, exactly. That's break-even is always referring to at expiration, but as you can see, your price will actually break even if the stock moves a little bit in your favor if it does it in a short enough amount of time. So if the stock moves, let's say, just 50 cents higher, but it does it in a relatively short amount of time, you will have a profit. It's just that profit is not guaranteed because it depends on a few other assumptions that we have to make, such as volatility. We assume that volatility will stay constant. These are the types of returns that you'll make. So you're absolutely right. There's just no other way for us to talk about when a strategy will break even prior to expiration. So that's why we always talk about break even at expiration. Is it possible to limit watch list high volume option stocks only? So Jim, we actually have a TMX watch list of pretty high volume stocks that are already pre-built for you here in an options play. So you can always look at that, the TMX watch list for that. That's already pre-built for everyone. Can options play send me a text or email when a stock on my watch list hits a certain price? So Ash, that's not a service that we currently offer, but that's a service that many brokerage firms offer. So I would talk to your broker. You might be surprised. Your broker probably already provides some type of service similar to that. Peter, you're very welcome. Greg, are you on any podcasts? Greg, I'm currently not on any podcasts on a regular basis. I do I do contribute to the OIC and sometimes on Options Insider Radio on their podcast, but it's not on a regular basis. The most regular basis for you to catch me are on these weekly educational webinars. And I do think that as far as for options education, the visual format is extremely important, because if I just sat here and talked a bunch of numbers and you couldn't see it on my screen, I find it quite difficult for most people to follow along. I find options related podcasts myself almost impossible to follow if I'm not seeing something visually, unless we're just talking about very high level concepts. So that's why I really prefer the visual format, so that you can see as I teach on these specific topics. Any other questions? Ed, John, RK, Serge, everyone, thank you so much. I really appreciate it. For those of you that are in the US, I will be at the San Francisco Money Show or Traders Expo this Friday, for those of you that are out there. If not, I am up in Canada, in Toronto, on September, I believe, 13th for the Options Education Day. So I do hope to see some of you there in September 14th, rather, in Toronto. So I hope to see some of you there. Otherwise, I really hope that you guys have found this useful. Again, this is one of my favorite strategies. This is one of my go-to strategies for taking a directional view when I do expect that large directional move. So I highly recommend that if you are looking at some stocks and you want to take some directional views, consider this as an alternative to buying a call or put option, because it does reduce the overall risk. And when you are correct on your views in the market, you will be able to get a outsized move. Serge, there is an Options Education Day rate for the hotel. You can find that on the Options Education Day website. Thank you so much. I hope you guys have a great afternoon. Have a great week for trading, and I'll see you guys in a couple of weeks on our next webinar, where we're going to talk about how to sell credit spreads, another strategy for more modest directional moves that you might have in the overall market. So thank you so much. Have a great evening, and I will send everyone the recording with the slides in about half an hour. Have a great evening.